Mortgage Buster, the new generation of mortgage elimination, will show you how to pay off your house and all your debts in record time, saving thousands and thousands of dollars of interest and taking years off the life of your mortgage note. This is not a bi-weekly program or a get-rich-quick scheme. This is not throwing extra money towards principal or debt consolidation. This is enlightenment, an education on a proven method that is based on simple math and current banking principles, all while you enjoy life and do more with your current income. These are secrets that banks probably don't want you to know. For our example, we will say that you're taking out a traditional P&I loan for your mortgage of $250,000 at 6% interest for 30 years with payments of $1,498.88. Your payments will begin January the 1st, 2008. So you go to the title company the day of closing and sign all the papers. And one of the documents looks similar to this. After the shock is worn off and it sinks in, you realize that by the end of 30 years, you paid double, more than twice as much as the amount borrowed. But remembering that your mortgage broker said most people refinance or sell their homes within the first 5 to 7 years, you go ahead and sign the papers anyway. And hey, 6% is a very good rate. How can the amount of interest be so substantial? The answer? The interest on your P&I mortgage loan is calculated on the daily basis. Let's glance at the amortization schedule of our P&I mortgage loan. As you can see, mostly interest is paid and very little of your payment goes towards the equity of your home. This vicious cycle is repeated month after month for 30 years. You deposit all of your income into your checking account, and from there you pay your mortgage. What's left over, you use to pay all of your other bills, payments, and living expenses. So once a month, you make your mortgage payment of $1,498.88 for 30 years until the loan is paid off. This totals over $532,000. Let's look at a traditional 30-year mortgage. As you can see, during the first 20 years, mostly interest is paid, and it's during the last 10 years when you can see the principal finally begins to reduce. Let's do the math. We have our example, and here's the amount of daily interest charged during the first 4 months. Now, the main point here is that your daily interest charged is only being reduced by a few pennies per month. This is why it takes 30 years to pay off your mortgage. Let's see the principal reduction of our $250,000 mortgage over the 30-year life of the loan. Look at year 15. You've already paid more than borrowed, yet you still owe over half the original loan amount and still 15 years of payments to go. After 30 years, that's a grand total of $532,867. And $282,867 is interest only. You pay your mortgage from your checking account, which earns little or no interest, and what's left over, you use to pay all of your living expenses. And ultimately, you end up paying over twice as much for your home. This is the way it's always been done. This is what I call a credit-based system. In the next video, I'm going to teach you a debit-based system, a new way of doing things that will turn your mortgage upside down so that you'll be able to pay off your home in 10 years instead of 30 without spending any more money than you are now. See you in the next video. This concludes part 1 of the video. To view part 2, click on the link below.